Hey there, it's Phil Ratcliffe with Rebel Financial, and thanks for joining in for another one of our broadcasts. Today, we're talking about something that hopefully should be pretty fun for us to review, and that is pop investing. And of course, pop, as we know it in many different ways, probably I would say culture and music is the most used term throughout history, right? So popular, so like things that are really in people's minds and what they're doing now. And right now, as we've come out of this recession, we're coming out of this pandemic, and the government's really supported things. A lot of people have come out of this way better than they went in. So it's kind of unprecedented, almost as surprising as how well the United States came out of World War II, right? You know, coming out of a depression, having a world war where millions and millions of people died. We were on rationing and sending troops across the world. You would think that would be quite devastating, right? So, not that obviously the world was in as dire straits as it was back then, but the surprisingness of coming out of a recession, people having more things and prosperity seeming better than ever. Now we'll see what happens 10 or 20 years from now when that debt comes home to roost. Hopefully, we'll do what we've always done as Americans, and hopefully we can come together as humans in the world and address these problems and beat them. But for now, things are looking really rosy. People have money they want to invest. There's a lot of technology out there to do it yourself and to be involved. So let's look at this. So I'm going to share my screen with you. We're going to look at a lot of things, and I got to keep it moderately brief. We'll put a lot of resources here. And before I get started, I just want to put out nothing that we talk about in this is investment advice to you. We're not recommending that you use something or another. Every person is different. You have different tax situations. Your income is different. You may be watching this from a different country. Your whole regulatory, legal system may be different. And of course, things can change since we've recorded this. So you should consult your personal financial advisors, whether that's someone like us that does financial planning or investing, or a CPA, accountant, or even an attorney. And even the attorneys have different specialties depending on what's going on in your life. Okay, so let's look here. And I'd have to say, one of the famous apps right now that are out there that you're seeing a lot of stuff about, Robinhood, right? So when this became popular a little over a year ago, and of course it's been out longer than that, but when it really became popular, like I even opened an account. I mean, I have multiple custodians do things institutionally, but wanted to try it. And you know what? I have really enjoyed Robinhood. It's a good app in terms of its functionality. I'm not trying to speak to people that are mad about the AMC and GameStop stuff. I'm not going to have an opinion about that right now, because I do think that regulatory wise, a lot of these broker dealers and custodians face a lot more problems than retail investors are concerned about. And on the flip side, I think the government and even the SEC and big business tends to support rich people, and it's not a fair playing field. But again, a lot of what the market manipulation that some of the Reddit investors have done too, that's absolutely illegal and not right either. So I think there's a lot of wrong going on. I think if we're going to enforce rules and be fair, it should be fair across the board. So anyways, in terms of the practicality, the technology, how this works is pretty great. This is one of the things I've really been trying to push on the institutional side for us, how we serve clients, is you guys need to be more like Robinhood when we talk about Schwab and TD and Fidelity and the traditional custodians. Robinhood is really quite awesome in terms of you can buy stocks, and you can buy mutual funds, and you can buy ETFs, and you can buy cryptocurrency. You can even buy options. So just a word of caution there. Like many technological things, Robinhood has made it extremely easy to do anything. And so one of the things you should do, and they have good learning things, and there's lots of other learning things that you can use out there, from American Funds and NerdWallet and our own blog, the Wall Street Journal. You can learn. Investopedia is a great one. You can learn a lot. You need to learn if you're going to really put your money out there at risk before you just go in here and let a bunch of these automated recommendations tell you to do things, and I'm just going to buy and sell. Because a lot of people will get on here and just say, well, I want to buy some of Tesla, or I want to buy some of Apple, and they just do it, and they just straight up put a market order. And for a lot of things that trade a lot, the spreads aren't that bad, and you'll probably be okay. But some things like the cryptocurrency and really small stocks, or if you get into something that's not traded, we call it's traded thinly, the spreads can be really big, which means if you just throw your order out there, then someone that is faster than you will go buy it low and sell it to you higher. So in a lot of these free trading platforms, this is how they make their money. They're selling you to the sharks out there to make money. So, be careful, learn how to use limit orders. Investing is very much different than gambling or speculating. A lot of what people are doing pop-wise by getting on this is more speculation and gambling, even though they think they're investing. But it's not much better than going to a bookie and putting a bet on your basketball team for the basketball tournament, right? So I think the technology here is awesome. There are some custodians like for us, as institutional money managers that are building out. One that I like, even though they're kind of at the beginning of their journey, is Altruist. You can check them out. Apex is actually the technology and custodian that Robinhood built their technology out on at first, before they got big enough to where they're like, let's just cut them out and keep more of the money. And they're doing a lot of cool things, and probably with some companies that you may have heard of, like Stash and Sophie. First Trade, and even that one that I was showing you before, Altruist, is built on Apex. And one of the things that we're going to talk about last, SPACs, is a special purpose acquisition company. Apex just got a bunch of money from a SPAC, and I've heard that they're going to do some exciting things with that. So stay tuned. We'll see. Some other investing tools that are coming out, or trends that you might have heard of, would be direct indexing. That's something that we're pursuing. It'll probably take us a year or two to really, kind of alpha, then beta, and then launch it out for people. But this is kind of how mutual funds went to ETFs. Now kind of buy our own stocks instead of having to go through funds. We'll see if it works, right? And with free trading and fractional shares, this could be a really cool thing. And one of the other trends we're going to talk about, like, is ESG, environmentally, socially conscious, good governance. This is a big trend that's coming around, and we can use this fractional shares and direct indexing to actually own the underlying companies, but still make a nice diversified portfolio, which, if we could leverage technology and artificial intelligence, et cetera, we could let clients, pick what they believe in terms of, like, what's their hot buttons. And then that AI would even help us vote the proxies with the companies, and we could take control, or at least make our voices heard. And, at best, or worst maybe for them, if we don't like the way that they're running those companies, we can fire their board of directors and executive staff, get executive compensation under control, et cetera. They work for us. They do. We own them. So, it could be really turning around to where we, the people, tell the rich people what to do, even though we feel powerless a lot in elections and stuff. So there's a lot of exciting things going on. So what's some more popular trends beyond just technology and apps and stuff? Because I think that's the juicy things that, when I put this title out here, that's probably what people were thinking. But there's more than that when we talk about investing, right? So popular things has been that large growth, large technology companies and whatso have really just been on a tear, and small and medium-sized growth companies as well too. So if we look at the last 5 years, you can kind of see that large growth has made almost 24% per year compared to large value. So what's the difference between growth and value? So growth just means it's a way that we look at it. It's a fundamental ideology of investing. So growth investors believe that, yes, it's okay to pay top dollar extra for companies that we think are going to grow faster. Value investors, kind of like Warren Buffett and his teacher before him, Benjamin Graham, that says, listen, you need to buy good companies, but you need to get them at a good price. You need to buy them on sale. Okay, so that's the value. And when we look back over the last 100 years, almost every time period, once you go over 15 years, when you roll it backwards, value beats growth by about 1 to 2% per year. So you may have heard value premium, the value premium. And so right now that is absolutely turned on its head. It's huge. And so when we look at the long term, value should be somewhere around, 10 to 12% per year. Large growth somewhere at around 9 to 10% per year. And another interesting thing is that large companies have really beaten small companies kind of across the board. And really, especially small value companies, have tended over the long term to be the absolute best category of stocks when you're kind of breaking it up like this. It's somewhere around 14% per year, 12 to 14%, depends on time period you're looking at, obviously. And the shorter we go, the standard deviation could be way higher than that. But you'll see here, large growth, which is arguably, when you look back through history, one of the worst of all of these categories, is almost double the best. So when you think about that, even in the short term right now, when we just look at the year to date, so we're right around mid-March in 2021 right now, you can see there's some of this correction coming back. The large growth, is negative right now, and small values really, kind of thumping it. But in terms of catching up, we aren't even a quarter of the way there if you have reversion to the mean. Reversion to the mean means a big system kind of getting back to its long-term average. So if there really is a significant reversion to the mean from what I'm telling you has happened primarily in the past, from where we are right now, there's a lot more pain for a large growth to go through, and large value and small value. And I didn't even show international. International is way behind, kind of like small value compared to large and mid growth. So keep that in mind, because right now the things that are really popular, like the FANGs, right? So like Facebook and Amazon and Apple and Netflix and Google, plus M and Tesla, so Microsoft and Tesla, man, that made up a lot of the entire market return last year. Huge. I mean, you can see like how, even though the S&P did terrific, look how much farther the FANGs are ahead of just the S&P. So it is this huge run up, and who knows? It could be. I don't know if you've seen that old movie with Wesley Snipes and Sylvester Stallone, Demolition Man. But after this whole terrible time frame, then Taco Bell ends up being the only restaurant out of all the restaurants. They won the restaurant war. So maybe the FANGs will defeat every other business out there, and there won't be any other companies or small mom and pop shops, and maybe they'll earn this way higher valuation, but I doubt it, right? So who knows what the future will be, right? We don't know. I mean, will there be antitrust in the United States and Europe against them? Will there be some small disruptor that comes up and changes things significantly and stomps Amazon just like they stomped Walmart? I don't know. But over long periods of time, things like that do tend to happen. And there are lots of things that could reverse these trends. So that is a huge trend. Be careful of it. So the FANGs. Another popular trend is the large and medium-sized growth companies. And of course, healthcare and pharma and biotech. You see that as being a very popular thing. And so, and also technology stuff, right? So like self-driving cars and batteries. You even see that some of the trends out there that people are interested in, like marijuana. And so you see different ETFs out there like YOLO and different things that people can participate, even though there really isn't direct marijuana ownership stocks and ETFs that you can buy right now in the United States. But they're still kind of getting this in a roundabout way exposure to it. So ETFs have really taken off, and a lot of the ones that are really low cost that'll track the popular things like the S&P 500 and the NASDAQ, or one of the ones that is really technology driven is called ARK. ARKK. And man, that just shot up to over $1 billion, it seems like overnight, even though, that had been on my radar for a while, but it's still surprising. Really popular. Okay. So again, be careful with some of these popular things, because while they may be great investments and great ideas, you still got to think about that Warren Buffett thing. You don't want to pay too much for something. It doesn't matter if something's awesome. If you paid 2 or 3 times too much for it, you're still going to lose money. Okay. So it's very important to think about, what you paid. So when you see some of these things that I'm saying, be careful. Some of the trends that may be the next 1 year to 5 to 10, who knows how fast things will go, would be that reversion to the mean. So you could see a big value versus growth coming back, and growth kind of staggering or just not doing as well for an extended period of time. You should see small companies doing better than larger companies. The US dollar and the US has just done phenomenal. You could see the dollar weakening, especially with all the debt and whatso that we have. And if that was to happen with other countries doing well and maybe even capturing a lot of our stimulus as we buy stuff with them with the money that we got through all these payments from the government the last couple of years, we could see foreign do really well, even though it doesn't seem like it when you look at the 3, 5, and 10 year on some of those things. So keep that in mind. The next thing we will talk about, is speculation. And of course, we could talk about cryptocurrency. We can talk about what happened with GameStop and AMC, and now there's been a lot of others. There's been a lot of speculation in crypto. Most people aren't watching that as close, and there are over 1,000 different cryptocurrencies now, even though the most popular ones are, we know them a bit more. We see them in the news. Bitcoin, right? Litecoin. You may have heard of Ethereum. So those are the big ones that people have heard of. And of course, Bitcoin especially, because you're like, oh, even Elon Musk is putting billions of dollars in there. And now these big US companies are doing it. So, this is a good paper by DFA, Dimensional Funds. We like them a lot. They do a lot of research, but they are, kind of old school, stodgy academic, and they're going to be conservative. And so, they talk about the technology, and there's a lot of uncertainty about supply and demand. And they say, well, if you're a conservative investor that's going for the long term, we don't know necessarily that they belong in a portfolio. I don't know that I necessarily, agree with that. I've actually been doing a series of kind of deep dive presentations for other institutional investors and advisors about blockchain technology. And I think probably in the next month or two, I may amend that so that I could do it for regular investors and change some things to where it would be okay. But this is a huge thing. Blockchain technology is going to change the world. Now, in terms of all those some that you could invest in, which one's going to make it? Who knows? It's kind of like, when there were tons of companies that could have made computers or could have made electric cars. Could you have called out who actually did it? And who knows that Tesla will actually be the winner in the end. One of these smaller startups could come out and just trounce them all. Or maybe Apple's car will be superb and put the other ones out of business. I really don't know. And it's tough to call on stuff like that. That's why a lot of times, doing the diversified approach, having an index type thing, let you kind of spread your money out on a lot of different horses. And even though only a fraction of them, maybe 10% will actually end up being winners, those 10% do so well that you can get an awesome compound rate of return, which is exactly what you want. Now, in the videos, we're going to post a lot of the links to these things. So if you want to come back and read them, that's why I'm not going through them. I can't make this forever long. So, check them out if you want to read it in depth. Kind of finishing up with kind of the traditional investing side of things. We talked about this a little bit. COVID is obviously a big thing right now, and we're thinking about early 2020s going to 2030. And a lot of the investment that we put into pharma and biotech could pay huge dividends in terms of, maybe curing cancer and tackling other issues that we didn't even think that mRNA technology would have been applicable to. It may not. We may have just wasted all this money, and people that are putting huge valuations in these things are going to lose a lot of money. Thinking about electronic payments and the future of digital payment apps and cryptocurrency and how that's going to change things. And, you can really see this purple, like how Asia is just so much ahead of us. And there's just so much more people there as well, too. We talked about, cure for cancer may be around the corner, and how much we're investing in some of that renewable technology. is going to be huge. I mean, you can see kind of where we are right now, how small our investment of wind and solar are and how much it's projected to increase. I mean, I have solar panels on my house and batteries, and I'm kind of an early adopter of this stuff, and it's awesome. And, from that, me using my computers to mine cryptocurrency, I've almost paid for all my stuff. So, like, to me, this is a no brainer. It's ridiculous to me that people are dragging their feet about this. But that's how the world is, right? A lot of people are not early adopters. They're like, let me see that it works and prove it to me for sure. And then after all that, I'm going to wait for the price to come down to ridiculously low, and then I'll get in on it when somebody will give me some tax credits, or I'll look dumb if I don't do it. And then, of course, electronic autonomous vehicles. I think autonomous is the really important thing here. I mean, come on, it's common sense. Electric motors are just way more efficient. We just didn't have the technology to store the energy. Now the batteries are coming along. And then beyond that, you have to make the infrastructure. And heck, that's been like a one-man show with Elon building his Tesla charging things right there. To me, those two things of really getting the data to let cars be able to drive themselves and building the infrastructure is the success there. Even though people just think electric cars that can go fast and can accelerate faster, yeah, that's obviously cool and it's fun, right? But that is not really what the breakthrough is. So what's not changing though? I mean, we've been having exponential growth almost since the birth of civilization. So just because these things are culminating doesn't mean it's going to change how we invest. You should still diversify your assets, put your eggs in different baskets, buy low and sell high. It's not hard. Again, don't get carried away in the boom periods, because it's really easy right now in a time period like this to think that anybody can do it. I can do it myself. I'm just going to play some bets. I've won in the past. I'm always going to win in the future. There's so many bad behavioral biases that we have as human beings and heuristics that at a certain point, you need to have a long-term solution and strategy, and not just a short-term speculative thing, because you can absolutely win 75 or 80% of the time, and you could get lucky to have all those stacked in the beginning and then make one. And so you did that from 25 when you first made some money when you're a growth all the way into you are 55, and then just one catastrophic mistake, one out of maybe like 20, and boom, wipe out all that you gained before. And so you really got to be careful about that. It is a deceiving thing to just think that just because you've won, recency bias, in the past, that's exactly what's going to happen. Okay. And it's not necessarily the case, and you could become a statistic. A lot of people do. So the next trend, and I hit it a little bit on it earlier, is values-based investing. So you may have heard ESG, environmentally, socially conscious, good governance. We also do Christian-based investing, and also halal, which is Muslim faith-based. And so our philosophy on this is, if we can empower people to invest per how they believe, that it would change the world. We don't necessarily have to say we're only going to serve people that think exactly like us. No, I think generally most people that hold any of these types of values are most of them are generally good people, and we keep trying to solve problems by passing laws and thinking that politicians are going to save us. Do you really think that anymore? They're not going to. None of them. I don't care which side they're on, who they say they're representing. They're not. We got to do it together, kind of in a let's solve problems type democratic, egalitarian way. And by us investing, we own a lot of this stuff, right? And like I was mentioning before, with like the open invest, and if we can get everything working with direct indexing, and we could vote our proxies and hold people accountable, versus thinking that the attorney general is going to do it. Come on, give me a break. They're more concerned with their records and where their career is going to go than doing the right thing in general. I mean, and per what their past history has been. How many people went to jail after the financial crisis? Boom. Right. There's probably a ton more people in jail right now for, having less than a certain amount of marijuana than stole millions or billions of dollars from people. It's so anyways, we can't trust them. We got to do it ourselves. They trust and believe in the mighty dollar. If we all put our dollars together, we could tell them all what to do and cut their salaries and raise taxes if we wanted to, whatever we wanted to, right? To make things right, we could do it. So we're trying to help enable people to be able to do that. Another tool that we're, this is kind of in the startup is, this company called Ethos, and, they can go through and people can pick what are the things that are important to them, and it helps us build portfolios to be able to implement them in per their values. And so this is just going to get better and better and better, and it's great. This is another piece by Dimensional Funds talking about, the opportunity of sustainability and why it's probably not only like something that's good for society, but also probably a pretty good investment. But how should we do it? So again, I'll link to some of this stuff so that you can see it. I don't want to make this too esoteric and long. The last thing I'm going to talk about, that's really coming around, and this is a piece by Capital Group, which you may know as American Funds. Good piece that talks about mergers and acquisitions, and you're just like, mergers and acquisitions, that sounds so boring. It sounds like something that you'd hear on CNBC or read in Wall Street Journal, but you may have heard of this, and this is probably the sexy thing right now, which are SPACs, right? Those special purpose acquisition companies. And there's a lot of people in the industry that are probably more on the more ethical side of things that say, SPACs are disgusting, they shouldn't exist. And that's because, really, if you think about it, there's a lot of rules and regulations about how and why people can, go into the market and sell shares of some new company that, could very well be a scam. Our capitalistic past is littered with people getting taken advantage of to invest in things that sound like great ideas, and they're charlatans. Or maybe it is a great idea and it could work, but they're just latching on to the idea, but not really putting the business acumen and everything behind it. So, in terms of going public and offering shares to the general public, yeah, it's bureaucratic and it's long, and maybe there are some unnecessary things, but there's a lot of protection in there of things they got to file and prove and, be transparent. So these SPACs, what they're doing is just saying, hey, just let us raise all the money and we'll get somebody that's experienced or famous to just say, trust me, I'm going to raise all this money, and after you trust me, I'm going to find some company to put it into, right? So that is the idea of SPACs. And oh man, they are raising some crazy money. And they're, to be honest, they're doing a lot of cool things. So, it's hard to say that this is bad when it looks like so many good things are happening. But the fundamental idea of what's happened compared to our charlatan past, this is probably not a good thing for the general investing public, because we're losing a lot of protections and a lot of people doing due diligence and what so. So will a lot of good things come out of this? Maybe. I hope so. I really do. But I'd say just be careful with SPACs if you're gonna get involved with it or whatever. This is like speculative. This is like some guy coming to you with this awesome idea, and you may make money on it for the first few years, and then it just ends up being WorldCom or Madoff or something like that. And they didn't even just limit things to accredited investors, meaning just cry me a river if you're rich and you lost your money. No, regular people could lose their life savings and stuff like that. Now, some people would say, well, they should have never put all their money in Enron. We can start cutting the dice and blaming people, but some of us can see the writing on the wall, what's going to happen in some of these, right? And again, it's always the bad apples that it ruins it for everyone else. So really, those are a lot of pop investing, some of the things that are coming along. I think it's really exciting. I'm really excited about things that are going on. We're trying to, if you think about who we are, we're a registered investment advisor. So we're a company that provides advice to our clients for a fee. We're always a fiduciary to our clients. So fiduciary means that we have to put our clients' interest before our own. And most of these companies that we talked about, even though they might be doing awesome things and they're good, a lot like doing some good things that are going to provide a lot of value, they're making great companies. Most of them are not fiduciaries, and so it's kind of wild west out there in terms of come buy this car, and if you get a lemon, tough stuff, right? So even if it's not us, if you are doing well and starting to build some wealth, like get a partner with somebody that understands this, and then you can knock heads together and say, these are the things that are right for me. This is how I want to put it together. And then I've always got someone to bounce ideas off of. And if I'm busy running my life and my family and stuff, I've got somebody to implement things for me as well too. That has to look out for me before how much money they make, right? So, anyways, I hope you enjoyed this broadcast about pop investing. It was definitely fun to put together. I enjoy keeping up on these things. Just interim, even when we're not doing a broadcast. So if you have questions, put them in the comments. Love to hear them. Like to have a conversation about it. Of course, if you have questions, need anything, let us know. If you need an investment advisor and we can help, let us know. Be happy to do a free introductory appointment just to see if we might be a good fit to be able to help you or vice versa. So have a super finish of the week. Thanks for joining again, and we look forward to seeing you next time.